I have received a couple of questions. So the first one is the condition for short-term benefit is 12 months from the date of accrual or 12 months from the date of reporting? See, under India's 19, the condition to classify a benefit as a short-term employee benefit is benefit is expected to be settled wholly within 12 months after the end of the reporting period in which the employer rendered the relative service. So the 12 months period is counted from the date of reporting, not from the date of accrual or grant. If employer expect that all the accumulated leaves will be availed or encashed within 12 months after reporting date, so the leave benefit can be classified as a short term. However, if any portion is expected to remain unsettled beyond 12 months, then it becomes a long term benefit and must be accounted using actuarial valuation under the project unit rate method. I hope this answers the question. Another question what we received is whether the attrition rate should be updated on yearly basis based on current reporting year experience, or can it be maintained the same for multiple years? What is the best practice? Okay, so the assumptions considered in the actual valuations are long-term assumption. The attrition rate assumption should reflect the historical trends, companies' future expectations, or industry or sectoral trends. If there are no significant deviations between the historical data and the future expectations of the management, then maintaining the existing attrition rate is reasonable. And the frequent changes in long term assumptions are not necessarily required. However, if the business environment, workforce composition, or the industry conditions changes, the attrition rate assumption should be updated accordingly to ensure the accurate liability measurement. Next question is how is discount rate and salary growth rate determined? Okay. See, the discount rate and salary growth rate assumptions for valuations, they are determined based on the economic conditions, industry trend, and company specific factors. So discount rate is set on a mark to market approach. It is determined by reference to market yields on Indian government bonds as at the end of reporting period. And accounting standard requires that the term of the bond should be consistent with the estimated term of obligation. Whereas the salary growth rate is estimated in reference to historical salary trends in the organization, expected inflation, industry standards, and the company policies regarding the increments and promotions. Usually, salary growth rate vary across industries due to difference in the salary structures, business cycles, workforce dynamics. Next question I can see is what is the basis of mortality rate assumptions considered in the actual valuations? Do actually use industry specific mortality rates or is a standard mortality rate applied across all companies? See, actuaries use standard mortality tables such as the Indian Assured Life Mortality, ILM, the table published by the Institute of Actuaries of India, as they provide a broad based estimate of life expectancy. However, in certain industries where the mortality experience significantly deviates from the standard, so for example, mining industries or construction industries, in that case, actuaries may adjust the mortality assumption based on industry specific data or company specific mortality experience. Ultimately, the choice of mortality rates depend upon the regulatory guidelines, available data, and the materiality of difference in mortality experience across industries. Next question I can see is, for leave encashment, does the actual valuation consider as employees' future leave entitlement? Okay, so answer to this question is no. Actuarial valuations are based on the leaves accrued on until the valuation date, and there are no allowance for future leave availments. Sorry, future leave entitlements. So under India's 19, why there is no OCI component for liability? Okay, so see, as per the requirements of accounting standard AS 15 and India's 19, the expense recognition for other long-term employee benefit plans must be routed through profit and loss account only. However, for defined benefit plans, or you can say post-employment plans, defined benefit plans like gratuity pensions, the expenses are split between the profit and loss account and the other comprehensive income. So as it's 5 p.m. now, I know there is a long list of questions, and we will try to revert you on the questions to each and every question which has been put up here in Q&A segment. As it's 5 p.m. now, so it's time to wrap up the session. And I thank you everyone for your time and attention. It was a pleasure sharing insights on this often overlooked but highly significant area of employee benefits accounting. Your participation and thoughtful questions have made this session truly enriching. We appreciate your engagement and interest. Thank you.